Welcome to the video. Today we will unpack the myths and realities of whole life insurance. We will compare it to term life plus investing the difference. And we will highlight who might actually benefit from whole life and who should avoid it. We will also provide a clear action plan with practical steps and a disclaimer. Let's begin. Here is the roadmap. First, we will cover the big idea. Next, we will explain why whole life underperforms for most people. Then, we will examine the math behind premiums and returns. After that, we will discuss traps, commissions, and sales tactics. We will then clarify the small group that might consider whole life. Next, you will get an action plan. We will include 2 short quizzes. And finally, we will wrap up with key takeaways and resources. Before we get into details, this is educational content only. It is not financial, tax, legal, or investment advice. Returns are not guaranteed, and past performance does not predict future results. You should do your own research and consult a qualified, fee-only fiduciary advisor who understands your situation before taking action. With that said, let's continue. The big idea is straightforward. Whole life insurance is sold as a combination of protection and investment. For most people, this combination is expensive and underperforms alternatives. Life insurance should be used for protection, not for investing. The better approach in most cases is to buy inexpensive term coverage for the years you need it, and invest the savings separately in broadly diversified, low-cost investment vehicles. Whole life policies typically require high monthly premiums, often around $440 per month for a healthy 30-year-old. While the cash value component grows tax-deferred, the returns are usually modest and can fail to keep up with inflation. Historically, broad equity markets have outperformed the internal growth of cash values by large margins. Many policies take more than 15 years before the cash value equals the total premiums paid, which means an extended break-even period. If you cancel early, surrender charges often lock in a loss. These structural features make whole life a poor investment vehicle for most people. This flowchart starts from the need for coverage and splits into 2 choices. The whole life path shows high premiums, allocation to insurance costs, and a low-yield cash value, surrender charges, and a long break-even period. The outcome is a costly product with limited flexibility. The term plus invest path shows a lower premium, the ability to invest the difference in low-cost index funds, exposure to market volatility with higher expected returns, and better liquidity. The outcome is typically lower cost and higher expected growth. Let us lay out a simple illustration. Suppose a whole life premium is about $440 per month, while a term policy with similar death benefit might cost around $25 per month. That leaves roughly $415 that could be invested monthly in a low-cost, diversified index fund. If you apply reasonable, conservative assumptions and account for fees, the compounding on that $415 over decades can materially exceed the cash value growth in a typical whole life policy. Additionally, the liquidity of a brokerage or retirement account is generally better than the loan-based access to whole life cash value. While whole life offers tax-deferred growth, you effectively pay for that through lower net returns and policy costs. These are illustrative, not guarantees. This table compares key features. Whole life has high premiums, slow-growing cash values, long break-even periods, limited flexibility, and opaque costs. Term plus invest offers low premiums, immediate savings, better liquidity, and greater flexibility and transparency. Whole life may fit a small group with advanced estate planning needs, while term plus investing suits most households seeking affordable protection. Be cautious of surrender charges that make it expensive to exit early. Accessing cash value typically involves policy loans that reduce the death benefit and can create tax issues if the policy lapses. Sales illustrations sometimes assume optimistic crediting rates that may not materialize. Agents may receive large commissions up front, which can drive aggressive sales tactics. Finally, messaging that mixes family protection with tax-free growth creates emotional pressure and blurs the line between insurance needs and investing strategy. Quiz time. The question is, what is the primary reason whole life policies underperform for most people? Option A, they lack any tax benefits. Option B, high costs and low net returns relative to market alternatives. Option C, they are illegal in most states. Option D, they provide too much liquidity. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Whole life policies underperform primarily because of high internal costs and relatively low net returns, which typically lag market alternatives over long periods. This pie chart depicts an illustrative early-year allocation of whole life premiums. A large slice goes to the pure cost of insurance, a significant portion to commissions and distribution, another portion to administrative fees, and only a smaller portion to actual cash value accrual. Actual allocations vary by policy and over time, but the point remains that substantial costs reduce the net growth of cash value, especially in the early years. Whole life can make sense for a very small subset of the population, typically the ultra-wealthy, who work with estate attorneys and tax professionals. In those cases, policies may be used for complex estate strategies after other tax-advantaged options are fully utilized. Even then, the purpose is often as a legal instrument within an estate plan rather than as a primary engine for investment growth. Here is a practical plan. First, quantify how much coverage you need based on income replacement, debts, and future obligations. Second, gather multiple term quotes and compare level term lengths. Third, automate investing the premium difference into diversified, low-cost index funds. Fourth, establish an emergency fund to protect against forced selling. Fifth, prioritize tax-advantaged accounts like workplace retirement plans, IRAs, and HSAs. Sixth, reassess coverage annually as your assets grow and obligations change. Finally, if you already own a whole life policy, examine surrender charges and alternatives, such as reduced paid up or a potential 1035 exchange, but consult a fee-only fiduciary advisor before making changes. This timeline shows two trajectories over 20 years. The cumulative premiums line rises steadily from the start, while the cash value line begins low and grows slowly. The cash value approaches or crosses the cumulative premiums only after approximately 15 years in many policies. Early years often have surrender charges, and growth tends to be slow in the first decade. This figure is illustrative, and actual timelines vary by policy. The second quiz question is: in many whole life policies, about how long does it typically take before the cash value roughly equals the total premiums paid? Option A, 3 to 5 years. Option B, 7 to 10 years. Option C, 15 plus years. Option D, it never equals premiums paid. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Many whole life policies take more than 15 years to break even because early costs and slow cash value growth delay the point at which cash value equals cumulative premiums. This mind map starts by asking whether you need life insurance. If yes, and affordability is important, the recommended route is term plus investing the difference. If affordability is not a concern, the next question is whether you are ultra-wealthy with significant estate complexity. If so, whole life may be considered with guidance from estate attorneys and fiduciary advisors. Otherwise, term plus invest still dominates. If you do not need coverage, then no policy is needed. Additional notes emphasize maximizing tax-advantaged accounts, understanding surrender charges, and keeping insurance separate from investing for most people. Here are the key points. Insurance should be used for protection, while investments should be used for growth. Whole life involves high costs, slow cash value growth, and long break-even periods. Term plus investing the difference usually offers better flexibility and expected growth. Whole life may fit only a small, ultra-wealthy segment with complex estate planning needs. Always work with fee-only fiduciaries and read policy details, including surrender schedules. To wrap up, purchase term life insurance for the period you need coverage. Invest the premium savings in low-cost, diversified funds. Keep insurance and investing separate to maintain clarity and control. If you are being aggressively sold whole life, remember the incentives involved and ask critical questions. For personal decisions, consult a fee-only fiduciary advisor. Thank you for watching. If you found this helpful, please like the video, share it with someone who needs to hear it, and subscribe for more clear, research-based money content. Tell us in the comments about your experiences with whole life versus term insurance and what you want us to cover next.